Welcome to the deep dive. If you've been keeping an eye on the crypto markets lately, well, you know the atmosphere has shifted dramatically and fast.
It really has.
Today, we're digging into the swift return of volatility, specifically with Bitcoin. After setting some really impressive new highs, it's just a completely reversed course.
It was an expected move, I think, but still pretty jarring. You have this incredible run-up, but when you look through the sources, the pattern we're seeing now is it's less about surprise and more about history meeting some very difficult economic headwinds.
And then the number that really just defines this whole moment is this. Bitcoin just entered bear market territory for the seventh time in the past 5 years.
7 times. It's an incredible statistic.
7 distinct drops of 20% or more in just 60 months. I mean, that stat forces you to confront the core paradox of this asset, right? How do you balance that extreme short-term volatility with what has been, phenomenal long-term growth?
And to set the scene, let's just quickly recap the timeline here. The momentum really started picking up after President Trump won the election last November.
Right.
That excitement drove the price to cross $100,000 for the first time back in December of 2024. Then the peak of this bull run came just last month, early October 2025, when the price got close to $126,000.
But in just the few weeks since that peak, the sentiment has completely curdled. As we're looking at the sources today, November 18th, 2025, the price has plummeted. It's down 27% to around $92,000.
A huge drop.
And that rapid decline, well, it confirms the new reality. We are officially in a bear market.
So our mission today is to really give you clarity on this reversal. We're going to unpack the immediate economic and policy factors, the things you're seeing on the front page of the financial news that triggered this sharp drop. Then we'll analyze what history, based on those previous 6 bear markets, suggests about the next year. And crucially, we'll evaluate why, despite all this turmoil, the structural long-term investment thesis for Bitcoin seems to remain fundamentally resilient.
That's a great roadmap. Okay, so let's jump right into the immediate causes. Before we get into the Fed, maybe we should establish the technical trigger. What exactly makes this a bear market?
It's a formal definition, really. A bear market is just marked by an asset declining by at least 20% from its most recent bull market high.
I see.
Bitcoin crossed that line on November 14th, dropping from its October 7th peak. And the speed of that drop, that itself tells you a lot about the nervousness in the market right now.
Nervousness is the key word. And the sources point to 2 big factors feeding that nervousness. The first one is all about monetary policy. Bitcoin generally loves lower interest rates, so what's the problem now?
The problem is what financial analysts are calling sticky inflation.
Sticky inflation.
Yeah. I mean, Bitcoin is a risk asset. It performs best when rates are falling, making money cheaper, encouraging, speculation. But the Federal Reserve's primary goal is price stability. And inflation just isn't going down like they hoped. We're seeing this persistent or sticky inflation in core services and, importantly, in housing.
And housing costs don't change overnight.
Not at all. They don't respond quickly to rate changes. So the Fed is trapped. They know they need to keep the economy stable, but high prices are still really hurting consumers.
Exactly.
So that stickiness has injected this extreme uncertainty into the market about that critical December Fed meeting. Investors, they just assumed rate cuts were a guarantee. Now, the risk is real.
What's the risk?
The risk is that if the Fed decides that this persistent inflation is the more severe problem compared to, say, slowing jobs growth, well then policymakers are going to feel compelled to hold rates steady, or at least signal a much longer pause than the market wants.
And the fear of higher for longer rates is just a huge gravitational drag on anything seen as speculative.
It absolutely is. When the cost of capital stays high, the expected future returns of an asset like Bitcoin, they get discounted much more severely. That fear just immediately pulls money out.
Which brings us to the second major factor, a broad rotation out of risk assets. It seems like investors aren't just selling Bitcoin, they're selling a whole range of things like high-growth tech stocks.
That's right.
What are the economic signals that are justifying this big rotation away from risk?
Well, the macro data has become profoundly confusing, and that's just the perfect environment for market panic. The U.S. jobs market, particularly over the late summer, it showed substantial weakening.
Which is normally a green light for the Fed to cut rates to stimulate things.
Exactly. But at the same time, inflation got worse, creating that classic stagflationary fear.
Right, that's the trap.
And the sources attribute this worsening inflation partly to policy decisions, specifically President Trump's tariffs. Well, tariffs basically function as a tax on imports. They raise the final price of goods for consumers, and that just makes inflation worse, even while hiring is slowing down. So the Fed is facing weak jobs and tariff-driven inflation at the same time.
A very difficult balancing act.
It is, and in situations like that, investors, they just seek safety.
So they rotate out of risk. Where does that money go?
It flows into safer havens, basically the opposite of Bitcoin. Things like short-term U.S. Treasury bonds, which offer solid, guaranteed yields and sometimes, very stable value stocks.
I see.
And when money moves that aggressively out of speculative assets and into bonds, the speed of Bitcoin's drop, that 27% decline, it suddenly becomes completely understandable.
That gives us the context for the drop. Okay, now let's shift to what history might suggest for the near future. And unfortunately, it seems to suggest a period of pretty muted performance after a shock like this.
That is the hard truth we need to relay.
Yeah.
When we look at the data from the last 6 times Bitcoin entered bear market territory, we see a pattern of consolidation, or what a lot of traders call the sideways slog.
Give us those stats. What does the source material say happens after bear market starts?
They really paint a picture of patience being mandatory. If you bought Bitcoin the moment it first closed in bear territory during the previous 6 cycles, your average return over the next 6 months was only 6%.
6%, okay.
But here's the most telling figure. The average return over the next entire year was a minimal 1%.
Wait, 1% over a full 12 months for an asset that's famous for these 100 or 200% moves.
1%.
Why wasn't the dip bought up faster in those previous cycles? What holds the price down for that long?
That's the critical question. It suggests a couple of things. First, capital exhaustion. The crash just washes out a lot of speculative retail money.
Yeah.
And it takes time for institutional capital, which is often much more patient, to step in and build a new floor.
And the second thing?
Psychological resistance.
Huh.
I mean, if you just got burned by a quick 20% drop, you're going to wait longer to see if the asset finds a stable bottom. You're not going to jump right back in.
And those psychological effects seem to translate directly into, time on the calendar.
They do. The data shows that the average time it took for Bitcoin to reach a new record high after that first close in a bear market was over 7 months. Specifically, 218 days.
So you're basically waiting 3/4 of a year just to get back to even, historically speaking.
That's the historical average, yes.
So history is warning us, be prepared for a frustrating sideways slog where the short-term gains are, minimal. But here's the counter-narrative, and this is why the long-term thesis isn't really discouraged by this data, right?
Volatility is the price of admission.
Exactly. That is the essential insight. Despite having suffered through 7 bear markets in the last 5 years, Bitcoin still delivered a jaw-dropping average return of 38% annually over that whole period.
The periods of hypergrowth just significantly outweigh the periods of these painful drawdowns. You don't get that 38% annual return without enduring the 7 bear markets.
So the lesson from history isn't don't invest. It's more like be prepared to trade sideways and understand that this volatility is fundamentally baked into the asset's long-term returns.
Exactly. It's a feature, not a bug.
Which leads us perfectly into our final and most optimistic section. Why does the core investment thesis remain fundamentally intact, even with this fresh haircut we've just seen?
Well, the long-term thesis is actually surprisingly simple. Supply is fixed, and structural demand is rapidly accelerating.
And what's driving that acceleration in demand?
It's being driven by 2 main factors. The approval of spot Bitcoin ETFs and what sources call a more favorable regulatory environment under the current administration. This combination is providing easy, regulated access for the biggest players in the world.
Let's break down the evidence for that, starting with corporate adoption. This isn't just small players dabbling anymore, right?
Not at all. We are seeing major corporations allocating real capital. The total amount of Bitcoin held on the balance sheets of public and private companies has more than doubled in the past year alone.
Wow.
And that represents a staggering 150% increase since the SEC first approved the spot Bitcoin ETFs back in January 2024.
That's explosive growth. But we do have to address the concentration risk in those numbers.
That's a crucial point for context, absolutely. While the trend is encouraging, a large percentage of that corporate holding is concentrated in one place. Strategy, which used to be called MicroStrategy.
Right.
Strategy alone accounts for roughly half of the total corporate holdings. But analysts still see the overall trend as positive because it signals greater comfort among corporate treasurers in general, even if it's currently led by a few very aggressive players.
Okay, now let's pivot to the really big money institutional adoption. This is where we look at those quarterly filings the financial world follows so closely.
We're talking about Forms 13F. For anyone unfamiliar, these are regulatory filings. The SEC makes investment managers who control at least $100 million in assets disclose their equity holdings every quarter.
So by looking at these Q3 filings, we can see exactly who is buying products like the iShares Bitcoin Trust or IDIT.
Exactly. And the data from Q3 is just overwhelmingly positive for the long-term thesis.
How so?
The number of large asset managers, those meeting that $100 million threshold, who reported positions in IBIT more than doubled over the past year. And what's more, the actual number of shares they hold increased by a sharp 154%.
That shows a really clear, rapid shift in how institutional investors see this asset class. It's moving from a fringe, speculative bet to a legitimate portfolio allocation.
Absolutely. And this brings us to the so what moment. This is what really dictates the future price potential. Institutional adoption is the ultimate long-term driver because these asset managers collectively command an astonishing $130 trillion in global assets.
130 trillion. That figure is just, it's almost abstract. To put that in perspective, if those managers allocated just 1/10% of that to Bitcoin, the impact would be seismic.
Precisely. If they allocate even a tiny fraction of that wealth into crypto, the price could increase substantially. When you look at the $92,000 price today, you're seeing short-term fear from inflation and the Fed. But in the deep background, that $130 trillion gravitational pull of institutional capital is still getting stronger every single quarter.
That definitely gives some confidence to the long-term thesis, even as we have to endure this seventh bear market.
So to synthesize all this, we have to keep the volatility front and center. Bitcoin is historically volatile, and that isn't changing. We have to be realistic. This current bear market could absolutely get worse if the economic backdrop deteriorates further.
Right.
Specifically, if sticky inflation forces the Fed into a really restrictive stance that shocks the economy.
And that means we always have to stick to the golden rule of high-risk investing.
We do.
Investors have to remember there is no guarantee that Bitcoin ever regains its previous high. So you should not put a single cent into the cryptocurrency if you cannot comfortably afford to lose all of it. It is still a high-risk, high-reward proposition.
That is the necessary warning. But let's leave you with one final thought to consider. We've seen the price plummet 27% from its peak, driven by short-term fear over interest rate decisions. So the question is this. Given that institutional investors command $130 trillion in assets and are adopting this asset at a 150% growth rate, does the temporary threat of economic headwinds, which are cyclical by nature, truly outweigh the long-term structural gravitational pull of that institutional capital?
Food for thought indeed. Thank you for diving deep with us today. We'll catch you next time.